What is an ARM? I've gotten a lot of questions about this in the last couple of weeks. As we've talked about, and everybody knows, rates have been moving around this year. So I've gotten a question, what is an ARM? And no, I don't mean the arm on your body. All right, ARM, or ARM, actually stands for adjustable rate mortgage. Now, see your look. Okay, an ARM, no, it is not necessarily a bad thing. All right, so an adjustable rate can be useful. When? To answer that question, I would always encourage you to talk to your mortgage professional. All right. So a lot of people know and understand what a fixed rate is. 15, 20, 30-year fixed. What that is or implies is that that rate is fixed for the entirety of that loan term. Okay. So 15, 20, 30 years, that rate is fixed for that period of time. An ARM is going to be structured differently. Now, I do want to take a moment and clarify. An ARM and a fixed rate can be on the same loan type, meaning you could do a conforming conventional loan on a fixed rate and an adjustable rate. The rate structure is what is different, okay? So fixed rate and adjustable rate can still be the same loan type. They're going to have different rate structures. Let me give you an example. So you hear the term 3-1 or 5-1 or 10-1, and there are different ARM structures, all right? But what those means, 3-1, as an example, your rate is fixed for 3 years, and then it could change every 1 year after that, okay? 3/1. Now, that does not mean that that is a 3-year loan, all right? So make that clear. The term of the loan can be just the same, could be 30 years. It's just the fact that the interest rate structure is going to be different. So 3/1, the rate's fixed for 3 years. It could then change every 1 year after that, for the entirety of that loan term, okay? Now, some of you may think, well, why would someone do that? And that's a good question, and it is not a one-size-fits-all. That's why I always encourage you to get a customized mortgage consultation. Call us with any questions. We're happy to discuss. But why would someone use an ARM as opposed to a fixed rate? Well, historically, the benefit of an ARM is that the initial rate, okay, the rate that's fixed for 3 years or 5 years or 10 years in our example, could be lower, okay? Again, we've talked about the fixed rate markets have been going up this year. There's no secret. Could continue to potentially go up. So again, if someone is buying a home and they're interest rate sensitive, an ARM could be another thing to consider. That's it for today, guys. Questions on ARMs, how they could potentially benefit you, what situations they would be right to fit in, give me a call, shoot us an email. We're happy to help.